You can't price out of the markets. Have price pretty much have split the difference between a 25 and 50. I would do 50. I think you got to get the funds rate to 4% quickly. And, you can't. I was looking yesterday at credit card delinquencies or charge-offs, auto loan delinquencies. Like, you're starting to see numbers that approach financial crisis. Not there yet, but you're starting to see this significant increase. 5 3/8 when you've got inflation running. I mean, I was looking at 3-month moving average. A bunch of the metrics are under 2 now, 5 3/8 when you got inflation running, let's say 2, the wrong price. Like, get it to 4, which is still restrictive. So could they do it? I think they should. Do I think, you have enough difference of opinion on that committee that they probably will say, let's compromise and do 25s, consecutive meetings? I think that's Jan's base case, and that seems right to me.
That was BlackRock's Rick Reeder, who joined our Opening Bid podcast earlier today. For more on the Fed's next move and what it means for investors, we want to welcome in Michael Sayers, Rockland Trust Vice President and Portfolio Manager. And Jay, there's always this discussion about what the Fed should do, what the Fed is going to do, what the Fed should have done. People love to have that one. What do you think the Fed is going to do, and what are the implications for the market?
Well, good afternoon, Julian. Thanks for having me back on the show. I think Rick's right. I think the Fed is ultimately going to start with 25 basis points in September. There's definitely the argument to be made, as Rick was laying out, that they could start with 50 if they think they have to move faster. But Jay Powell has shown that he really likes to build a consensus on the committee, and when they move, they like to move unanimously. So I think ultimately they're going to come down with a 25 basis point cut in September.
And what's your take on the overall health of the U.S. economy here? We had, of course, Mike, that kind of growth scare. We saw the panic selling off that last jobs report. Then you got some more economic data points, and it seemed to give investors obviously more confidence. But what is your take?
Sure. So my take for pretty much the whole year has been, the economic momentum, has been strong. It is slowing. And the consumer is slowing as well, but the consumer is still not weak by any means. So ultimately, though, I do think sooner or later, hopefully sooner, we are going to need some Fed rate cuts to stabilize the economy, especially if we want to see a reacceleration in GDP in 2025. I think what's really keeping the economy afloat this year is just the amount of fiscal support that we're getting. So we're still running the budget deficit at 7% or so of GDP. The Biden administration has been forgiving student loans. They also just restarted a legacy pandemic era program, the employee retention tax credit. So that's getting money back to small businesses that kept employees on during the pandemic. So they've been kind of pulling out all the stops to keep the economy running. But sooner or later, we're going to need lower interest rates to reaccelerate here.